Today, I'm going to be sharing a simple step-by-step breakdown of my 4-step trading model that made me profitable. So without wasting a minute of your time, let's get right into the 4 steps of it and how you guys can start implementing this into your own trading. So my trading model is called the STIM model, which stands for Sweep, Tap, Inversion, Momentum. But instead of just showing you guys what that looks like, I'm going to be explaining the significance of it as it relates to my trades and why I take them, okay? So these are the 4 steps. Remember this, write it down, do whatever you need to do. So the first step is a sweep. Basically, we just want to see a liquidity sweep. So say we're looking to take longs. Say we have a swing low that we already made, and then we come back down and come under it, okay? At that point, that's the first step because we have now swept out this previous low. So we have swept liquidity. So that's the first thing I always want to see. I want to see some swing low get taken if I'm starting to look for longs, or some swing high get taken if I want to look for shorts. Because obviously, if we're shorting, we can look for the same thing, just flip the chart upside down, right? So we make a swing high, we come back down, we take it out, and then we're looking for our move downward. So the first thing I want to see is always going to be a liquidity sweep. Now, why do I want to see a liquidity sweep? Well, whenever you get a liquidity sweep, for those of you who don't know what it basically is the market stopping participants out and the big money getting in at a discount relative to where the past participants were in. So for example, right here, a lot of people are going to have their stop losses on longs at whatever obvious swing low this is, right? So say this is some obvious swing low on the chart. So what's going to happen a lot of times is price is going to get pushed under that level, not only to stop out the longs, but also to entice shorts to chase this breakdown. And then what's going to happen is the smart money, the big money is getting in down here. They're taking their long positions at a discount relative to where everyone else was in, and they're buying their long positions from people who are FOMOing to short this breakdown, okay? So when you have a liquidity sweep, you're basically trading a reversal. That's the best way to frame it. But the reasoning for the move in your direction, if you're playing with the liquidity sweep, is the fact that it takes the weak hand market participants out of your trade, okay? And so that's going to make it a stronger move back in your direction most of the time for the smart money who participated at this discount. Now the T stands for tap. Tap into what? Well, you want to tap a fair value gap. So say we have a set of candles. So for the T part, notice right here, we have this bullish fair value gap. So what you want to see is you want to see a move back into one of these and then trade in the direction that it's supporting. So say we have this bullish gap right here. Well, you want to be looking for longs when you come back into one of these. So now I want to show you guys how to combine steps 1 and 2, which is the sweep and the tap, okay? So we're going to zoom in on this and pretend this is like the 1-hour chart or something. And then say that you go to a lower time frame, like the 15 or 5 minute, whatever time frame you want to use for entry. I tend to use anything from the 1 minute to the 15 for my actual entry, and the 1 hour, 4 hour, and daily for my actual bias zones, like these higher time frame gaps. So imagine we have this bullish fair value gap, right? And then in this area, we create some type of intermediate swing low, and we chop around above it for a little while, and then at the bottom of this candle, we come and take it out. That's when you want to be looking for longs, right? And that's when you're often going to see continuation in your direction, because we took out a swing low inside of a bullish fair value gap. So if that adds up, right, like you're not only sweeping liquidity, but you're also being supported by the structure that the market has built, which is this bullish fair value gap. Now, a lot of times you're going to see a pattern like this and people are going to think about it as a bull flag, right? They'll say bull flag this, bull flag that, yet they can't explain what's pushing the price back up past the bull flag. Well, it's because market participants that are long are getting stopped out during this consolidation, and then you're going to have some type of manipulation to move back up, right? So that's where you want to be getting in after the manipulation. But the key is when it's happening inside a bullish gap if you're long, or when it's happening inside a bearish gap if you're short. Manipulation, liquidity sweeps, they're always going to be something to look for, but the highest probability plays that can be made off of them happen when you are inside a gap that's supporting your bias, okay? So for long bias here, we want to wait to see a manipulation lower, past some type of swing low in this gap, and then we deliver back to the upside, okay? So that's how you're going to combine steps 1 and 2. Now, the third step has to do with the manipulation leg itself. So say we have this low, right? We come and sweep it, that's inside the gap. what exactly do we want to see happening on this leg right here, this part of it, that bottom, that reversal? What do we want to see? That's where steps 3 and 4 come in. So imagine this set of candles is on the lower time frame. We've already tapped into the higher time frame fair value gap that we use to dictate our bias. We've already swept out a low or high for shorting inside of said gap. And now we want the last two steps, which are inversion and momentum. So what inversion means, for those of you who don't know, is an inversion of a fair value gap. Basically a fair value gap getting ran through and disrespected, just completely fucking violated, okay? That's what you want to see on an inversion. So what does it look like, okay? So this is ideally the type of price action you want to see on that liquidity sweep. You want to see some aggressive move down if you're longing. Once again, you flip all of these scenarios if you're shorting. You'd want to see an aggressive move up. So if you're longing, you want to see an aggressive move down, an impulse move that leaves a bearish fair value gap. So we're going to mark it in gray to kind of exemplify it. So this right here would be a bearish fair value gap. Notice how we have an impulse move, and this is just kind of an example. So that's a bearish gap. Now, the inversion happens when you close back above this, right? That means this bearish fair value gap got disrespected, because in the ICT 2022 mentorship, the way it's taught is that price is going to come back to retest the fair value gap, and it's going to serve as an area for continuation, right? So we're going to have something along the lines of this, right? A dump, we create this bearish gap, we pull back up into it, and then continue to the downside, which is often what's going to happen. That's when a fair value gap is being respected. Now, when a fair value gap gets disrespected, it just looks like this. We completely run through it to the opposite direction. That means that the momentum is strong on whichever side that's happening. So in this case, this would be a bullish inversion because we are disrespecting a bearish fair value gap, which means the bullish momentum is very strong at this point in time. So that's what the IM means. Inversion, momentum, okay? So obviously you can flip this as well. If you're looking to short and you have a big impulsive move up that leaves a bearish fair value gap, you sweep some type of high, it's inside a bearish fair value gap on the higher time frame, and then you just completely knife through that bullish gap, you can deduce the momentum is strong to the bear side, and that's going to set up a good short. Now, the momentum is key here because obviously sometimes what you're going to have is a bearish fair value gap created on your entry time frame, and you're kind of just going to hang around a little under it. You're going to chop a lot, and then maybe finally you'll like crawl back up through it a lot later. That's not the type of trade you want to take. The more V-shaped the reversal can look, the more severe the displacement back through that bearish gap is if you're longing, or back through that bullish gap is if you're shorting, the better setup and better continuation you're likely to get. So that's the 4-step strategy. Sweep, tap, inversion, momentum. So now that we have a full understanding of each step, let's put them together one more time, and then I'm going to show you guys some actual chart examples, okay? So say we have a big move up, right? And we create our higher time frame bullish fair value gap. Now this is the fair value gap we're charting in pre-market to establish our bias for the day or week or whatever you want it to be. And we're going to say, okay, I want to see us manipulate back down to this, take out some sort of liquidity that we put in, and that's when I'm going to look for longs. So we're going to chop around, right? We're going to put in a swing low right here, then maybe chop around, and you're going to mark that because this swing low is in very close proximity to this bullish gap. And then what you can know is that if we get a move down and we manipulate below it, that's when you want to be looking for a reversal, especially if we zoom in and you see that we left any type of bearish fair value gap on the lower time frames on the way down. We'll mark it in red. And the second that you deliver off this bullish gap and invert this lower time frame bearish gap, that's when you want to be going long. And that's when you're more likely to get strong continuation to the upside. Because we all know stocks can't just go up forever. Why? Because the market makers don't want you to win. The algorithms don't want you to win. They want to get their entries at a discount relative to you. So while some people are getting euphoric and chasing entries right here because they think we're going to go up forever, that's exactly when the market's going to come, start to chill out. And just when people think they're safe and they're going to move straight back up after consolidation, we're often going to get a violent manipulation leg to the downside like I'm showing right here. That's when you want to be buying, okay? Think about it. If everyone wants to be buying up here for longs, and everybody's going to get scared shitless and sell out down here, then don't you want to be the one buying down here and selling when we get back up here instead of the other way around? Instead of buying here and selling down here when you get panicked out? Yes, of course you want to be that person. You do not want to be the person that sells low and buys high. You don't want to be that. And this model is actually specifically engineered to make you not be that. That's the whole goal of this model. We're trying to buy at a discount relative to your average market participant. Now, here is an example of the STIM model working in real time. Now, I actually trade ES and NQ, but this does work with pretty much everything. I've had other subscribers tell me. I actually have a free trading Discord that you guys can join. Just click the link in my YouTube bio and you're in. Be part of my community. I'll answer whatever questions you have. But I bring that up because a lot of the people in there trade Forex, they trade gold, any type of crypto you can imagine, regular stocks. It works with everything, but I mainly trade ES and NQ. That's my preference, so that's what I'm going to go over. I will go over an Ethereum example as well in a minute. But so right here is actually a very, very good example of a STIM model playing out. So you have this bullish fair value gap right here, right? And then you have this internal low, and we come down and we sweep it. So as you guys can see right here, we come down and sweep that swing low. Now, when you see a candle like this, you can also start to see what I meant by a lot of market participants will get scared out. Because look, they thought we were breaking out up here, right? When we closed above these previous highs, only to manipulate back to the downside. And a lot of them probably have their stop set around this area because they think to themselves, oh, well, if it's an uptrend, we have to make a higher low, so we can't come and break that previous one. So therefore, if we do, I'm going to get stopped out. I'm going to set my stop here. Well, look at that. They all get stopped out. We have a violent move to the downside. Little do a lot of people know that we're starting to deliver off a bullish fair value gap right here. And that's where the STIM model comes in. Because you can also tell now, after the next candle forms, that we have created a new bearish fair value gap. Now, can we come back up to this and reject like the ICT classic model teaches? Yes, we absolutely can. But that's why you have to wait. You never take a STIM model trade if the inversion hasn't happened. You don't take it because it looks like it's going to happen and, you know, you're looking at the 1 hour chart and there's only 10 minutes of the candle left. It looks like it's going to invert. No, you need to wait till the candle closes. So after a little bit, you can see that we end up getting a nice close above, right? So right here. So this would be your entry, and you would target probably these equal all-time highs right here. And you would set your stop to break even at this internal high right here. So that's the STIM model, right? We've swept this liquidity. We've tapped into a higher time frame gap. We now have an inversion, and you can tell the momentum is very good. So that's a perfect example. Now let's go to Ethereum, because this is one of the best STIM model setups I use in terms of showing people how the model works, because I've gone over this many times and it is a very, very good model. Okay, so with Ethereum, we had a daily STIM model this summer that was one of the best and clearest examples I have ever seen. Okay, so look at on Ethereum. We have a whole collection of lows inside of this range where we had been chopping for over a month. Okay, so a lot of traders are getting antsy. They think we're going to break out. They think we're going to do it here. It's a fake breakout. This was actually manipulation too. We came back, sold down, and then we start to take out all of the lows inside of this range. So right here, a lot of people are going to want to go short, right? Right here, when they see this, it's going to look very bearish. Now, why would you never go short here? Well, if you followed the STIM model, you would have looked for longs. Why is that? Because we have swept all of the liquidity inside of this range, not just one swing low, but several. So that's the first thing you want to keep your eye on. Anytime we sweep out all that, that means the institutions are now more likely to try to get in because you've all stopped out and they want to get their discounted entries. So also notice, after we sweep out all these swing lows, if you go to the weekly chart, look what we have. A massive bullish weekly fair value gap. Now that is very significant. And those are not going to get fully disrespected very often, especially not on the first try. So with that context in mind, now you go back to the daily chart and look, you zoom in a little more and we have a bearish fair value gap right here that we created on this move down to sweeping out liquidity. So now all we do, we wait for a move back up through it and we get it the very next day. So this was easily manipulation. You can identify it the second that happens. You see this move right back up. You see the inversion. You see the tap out of the higher time frame gap with clear momentum because it was the very next candle we knifed all the way back up or pumped all the way back up through the gap. We know now that's manipulation. Okay, and look what happens because we have a very logical target as well. All these relative equal highs at the 4100 range, clearly a draw on liquidity for Ethereum. So like I said, this 4100 range was the good target. I actually took this. I will put up the screenshot. I called this out on my Twitter for free. You guys can go follow. But this was a classic STIM model, the most obvious entry I've ever seen. And it's just a good example to show you guys how the structure works, right? You get that impulse leg. It's just like the, drawings I had at the beginning of the video. You get that impulse leg up, you chop around, you set some lows up inside or right around a bullish gap if you're longing. Then you come down, take them all out, and that's when you can finally continue upward once most people have gotten shaken out of the move. And you can see that it doesn't even take us long to just absolutely go on a tear. And as a result of this move, we actually end up making new all-time highs. And now we're just kind of chopping again, okay? So very, very nice movement, right? Very nice movement on Ethereum. We actually had another STIM model right here, right? This was another STIM. This one that we just had the other day, another STIM. Looks like Ethereum's going to probably now run, take all of these highs out, make new all-time highs. Who knows where it'll stop, but it looks like another model, right? Because we've swept out the lows. We are actually inverting on the daily as we speak. So that's my theory. The STIM model is goated, and you guys can try this for yourselves. Do not take it from me. Go and back test this for yourself. Forward test it for yourself. If you're not comfortable with the model, if you're not comfortable with these concepts, do not trade with your real money or risk anything. I'm not a financial advisor, but that's just common sense. But like I said, with the STIM, right? It's sweep, tap, inversion, momentum, STIM. You can think about this like cake ingredients. Some people like the chocolate. Some people like the frosting. Some people like the eggs. Some people like those things in and of themselves. It's the same thing with this. Some people just like trading off liquidity sweeps. Sometimes people just like trading off taps into a higher time frame fair value gap. Sometimes people just like using inversions. But if you combine all these ingredients into one, you're going to get a more enjoyable, more consistent, less varied result. That's how I think of the STIM model. It's like ingredients. You put them all together, you're going to make a good recipe. Can the ingredients be fine on their own? Yeah, some of them. But it's never going to be as good as putting them all together and letting them cook, okay? So that's kind of how I think about the STIM model. And that's what it is. I've explained pretty much to the T everything there is about it. This model has made me profitable. You can watch my other video where I talk about how I had my best month ever, and I'll put the stats up right now. Over a 55% win rate, but I was making 1.7 times as much on my wins as I was losing on my losses. So that adjusted win rate is well in the 70% range. If you just adjust that together, maybe even higher. I'm not good at that type of math off the top of my head. But like I said, very good trading model, but don't take it from me. Take notes on this video and then go test this stuff out for yourself and see how it feels for you. Because at the end of the day, everybody does have a different style, and I believe this will work for anybody who gives it the time, but maybe it's not your thing. At least give yourself the chance to see. And like I said, if you've got any questions about it, join my free Discord. It is linked up in my YouTube bio, and I can answer them. I interact with all you guys and all that stuff. So if you're still watching this video, you're probably very serious about trading. If that's the case, make sure to like and subscribe so you can see more of my educational content and all of my videos that I post about my trade recaps using this exact model, all that stuff. You'll become very familiar with this after watching a decent amount of my videos, so I'd encourage you to check my other stuff out. I have a playlist that's coming up right now, linked at the end. And like I said, make sure to join my free community if you want to have any questions or if you just want to interact at all. I'm a small creator, so I make time to get back to everyone, and I really appreciate you all who support this. So I'll catch you in the next one. Peace.